Did you know that there's a way to invest in Canadian real estate without buying a single property? While everyone's focused on REITs, savvy investors are earning 6 to 12% dividends through mortgage investment corporations. These unique financial vehicles let you become the lender instead of the landlord, pooling in capital with other investors to fund mortgages across Canada's $30 billion private lending market, according to Perch Capital. No maintenance, no property management, just monthly income flowing directly to your account. Stay tuned to see how MICs turn mortgage payments into monthly cash flow without the hassles of ownership. Today, I'm breaking down the exact structure of MICs, who can invest in them, and how they generate those impressive returns. Without further ado, let's dive into it. Canada created mortgage investment corporations through Section 130.1 of the Income Tax Act. The government's purpose was clear: to give everyday Canadians access to profitable mortgage lending markets that had previously been dominated by banks and large financial institutions. What makes MICs truly unique is their strict regulatory framework. These aren't optional guidelines. They're mandatory requirements that determine whether a company qualifies for MIC status. If a company fails to meet these conditions, they lose their special tax advantages. The rules establish that MIC must maintain at least 20 shareholders, with no single person owning more than 25% of the shares. This prevents concentration of control and ensures broader ownership amongst investors. For asset composition, at least 50% of a MIC's asset must be invested in residential mortgages, CDIC, insured Canadian bank deposits, or cash. This requirement keeps MICs focused on their primary purpose, providing mortgage financing to Canadians. MICs face additional restrictions on their activities. They cannot manage or develop real estate properties. Their role is strictly limited to mortgage lending. They can't fix or flip houses, build properties, or operate rental buildings. This keeps them focused on their core lending function. MICs can own some real property, typically through foreclosure, but this is limited to prevent them from becoming property holders rather than lenders. These rules create something special: a focused investment vehicle with significant tax advantages. MICs bypass corporate tax by distributing 100% of their net income to shareholders under Section 130.1 of the Income Tax Act. This act treatment is fundamentally different from normal corporations, where profits are taxed at both the corporate and shareholder levels. For investors, this tax efficiency is a major advantage. The money that would normally go to corporate taxes flows directly to your pocket. This structure is why MICs can offer those 6 to 12% returns mentioned earlier. When comparing to other fixed income investments like bonds or GICs, remember that MIC returns don't have that initial layer of corporate tax reducing their yield. The government created this tax structure intentionally to encourage private mortgage lending by making MICs attractive to investors. The strategy worked. Today, MICs manage billions in mortgage assets across Canada, providing financing to borrowers who don't fit the strict criteria of major banks. Understanding the legal framework helps you see why MICs work the way they do. Every aspect of operation stems from these fundamental legal requirements. The strict rules create a unique investment that generates high yields through tax efficiency rather than taking excessive risks. When you invest in a MIC, you're benefiting from a tax structure specifically designed to reward mortgage investors. The government allows the MIC to act as a conduit, collecting mortgage payments and passing them directly to you without the tax burden faced by normal corporations. But what exactly happens to your money when you invest in a MIC? Your investment follows a specific path that most people don't fully understand. Let me walk you through exactly how your money works inside a MIC. The structure is designed to separate control from economic benefits through a specific share agreement. MICs typically issue two main types of shares: common shares and preferred shares. Common shares carry voting rights, giving holders control over the company's decision and direction. These shares are held by the founders, managers, and operators of the MIC, allowing them to decide which mortgages to fund and how to run the business. However, common shares receive minimal economic benefits. As an investor, you'll purchase preferred shares, which entitles you to a prorated share of all the mortgage income generated by the MIC. While these shares typically don't come with voting rights, they receive all the economic benefits, meaning all the dividends from the mortgage interest payments. This clear separation ensures professional management while directing profits to investors. When you deposit funds into a MIC, the company issues preferred shares in exchange for your capital. Your investment isn't tied up in any specific mortgage, it's spread across the entire portfolio, creating immediate diversification. This is a key advantage of the MIC structure. Your money joins a pool of capital from many other investors. This pooling creates significant lending power that would be impossible for individual investors to achieve alone. For example, a MIC with 100 investors, each contributing $25,000, now has $2.5 million to lend out. This allows the MIC to fund larger mortgages and spread risks across many different loans. If one mortgage defaults, it only affects a small percentage of the overall portfolio. Manager sources deals, underwrite loans, handles legal work, and collects payments so you don't have to. They find investment opportunities, analyze mortgage applications, negotiate interest rates, and manage all fund administration. This professional management means that you can participate in mortgage investing without specialized knowledge or connections. One specific advantage of the MIC structure is that your investment can be held in registered accounts like RRSPs and TFSAs. This makes the return even more attractive since you can shelter the income from taxes. The pooling system allows you to start with a relatively small investment, typically between $5,000 and $50,000, with an average around $100,000, while gaining exposure to a diversified portfolio of mortgages. This is similar to how mutual funds work for stocks, but applied to the mortgage market instead. When borrowers make their mortgage payments, that money flows back to the MIC after covering operating expenses and management fees. The income is distributed to all the preferred shareholders. Your portion is determined by how many shares you own compared to the total shares outstanding. If you try to invest in mortgages directly, you'll need to find borrowers, assess their creditworthiness, handle legal documentation, register the mortgage, collect payments, and deal with any defaults. The MIC handles all these complex tasks for you, making mortgage investing accessible to regular people. The combination of professional management, risk diversification, and the ability to start with a moderate investment makes an attractive option for investors seeking income. Instead of putting all your money into one or two mortgages, you're spreading it across dozens or even hundreds of different loans. But have you ever wondered where exactly your investment goes after it's pooled? The types of mortgages a MIC funds might surprise you. MICs deploy capital in ways that create opportunities for both investors and borrowers. Let's examine where your investment actually goes after it's pooled with other investors' funds. Once a MIC has collected capital from all its investors, the managers begin searching for suitable mortgage opportunities that match their investment criteria. These opportunities typically come from mortgage brokers, real estate agents, and sometimes directly from borrowers themselves. What makes MICs distinct is that they serve borrowers who don't fit within traditional lending criteria. Because banks require strict credit, income documentation, and standard property types, MICs step in for self-employed, credit-challenged, or construction loans. This creates a perfect symbiotic relationship, borrowers getting the financing they need while investors earn higher interest than they would through conventional fixed income investments. Self-employed individuals represent a significant portion of MIC borrowers. Consider a contractor earning $150,000 annually who writes off numerous business expenses. Banks look at the tax return showing a much lower income and decline the loan. MICs, however, evaluate the actual business income and provide financing when traditional lenders won't. Construction and development loans form another key segment of lending. Traditional lenders often avoid these loans due to their complexity and perceived higher risk. A developer building a small subdivision or a homeowner constructing a custom residence might struggle to secure bank financing. MICs provide the short-term bridge financing that makes these projects possible, filling a crucial gap in the market. The loan terms offered by MICs are typically shorter than bank mortgages, generally ranging from 6 to 24 months rather than the 25 to 30-year terms common with conventional lenders. Borrowers use these short-term loans to solve immediate financing needs with plans to refinance with a traditional lender once their situation improves or their project reaches completion. This short-term nature creates constant cash flow as loans are repaid. Every month, some mortgages in the portfolio mature and the principal returns to the MIC. This continuous recycling of capital allows the MIC to adjust to changing market conditions. If interest rates rise, the MIC can gradually increase rates on new loans as older ones are paid off, making MICs more adaptable than traditional fixed income investments. MICs provide a crucial gap in the lending market by providing flexible, fast financing. This flexibility allows them to charge higher interest rates than conventional lenders, typically 5 to 6% higher than traditional lenders in Canada. This premium reflects both the increased risk and the value of flexible terms offered. These higher rates directly benefit you as an investor. When banks say no, MICs says yes, and charge accordingly for taking on that additional risk. Your investment provides valuable financing options for borrowers while generating strong returns for your portfolio. MICs aren't subject to the same strict lending guidelines required for traditional lenders. This allows them to offer individually tailored loans that meet specific borrower needs. While some banks use automated approval systems that reject anyone who doesn't fit the standard model, MICs evaluate each application individually, considering factors that automated systems might miss. By funding these non-traditional mortgages, your MIC investment helps borrowers achieve their real estate goals while generating strong returns. But what exactly creates those impressive MIC returns of 8 to 12%? The answer isn't just one factor. It's a combination of revenue streams that work together to outperform traditional fixed income investments. MICs create value through a sophisticated revenue model that combines multiple income streams to deliver superior returns. Let's examine the financial engine that powers these investment vehicles. The primary revenue generator is mortgage interest, typically charged borrowers between 8% and 14% on their loans, significantly higher than conventional lenders. This premium reflects the specialized lending services MICs provide to borrowers who don't qualify for traditional financing. When you invest in a MIC, this interest income forms the foundation of your terms. Fee income provides a substantial secondary revenue stream. MICs collect various charges throughout the mortgage lifecycle, including application fees when borrowers first apply, lender fees when loans are issued, renewal fees when mortgages are extended, and prepayment penalties when loans are paid off early. These fees enhance the overall yield beyond what interest alone would provide. The third revenue component comes from reinvestment. As mortgages are repaid, the returning capital is quickly redeployed into new loans. This continuous recycling ensures that funds remain productive rather than sitting idle. In rising interest rate environments, this frequent turnover allows MICs to gradually increase their portfolio yield as older loans are replaced with higher rate new mortgages. From this gross revenue, MICs deduct their operating expenses and management fees. Management fees typically range from 1 to 2.5% of assets under administration, while operating costs cover essential business functions. After these deductions, the remaining net income is distributed to shareholders. What makes MICs particularly secure is their conservative lending approach. Most MICs maintain a loan-to-value ratios between 60 to 85%, with many targeting the 65 to 75% range. This means they're lending significantly less than the appraised value of the property securing each mortgage. This built-in equity buffer provides substantial protection against market downturns. For example, a MIC that lends $700,000 on a $1 million property has a 30% cushion before a loan would exceed the property value. Even if real estate prices decline, this conservative approach helps protect the principal investment. Each mortgage is secured by a legal charge on the property title, giving the MIC the right to take possession and sell the property if the borrower defaults. The tax efficiency of the MIC structure further enhances returns. Unlike regular corporations that pay corporate tax before distributing dividends, MICs pass all the income directly to investors without corporate-level taxation. This flow-through structure means more of the revenue reaches your pocket. When you combine high interest rates, multiple fee income streams, and tax efficiency with the security of real estate collateral, you can understand why they often deliver those impressive returns of 6 to 12%. This performance significantly outpaces traditional fixed income investments while maintaining a reasonable risk profile thanks to the property security backing each loan. The MIC revenue model creates a reliable income stream that many investors find attractive, especially in today's uncertain economic environment. But once a MIC generates this income, how exactly does it reach your account? The process of turning mortgage payments into investor dividends follows a specific path that's worth understanding. Let's examine how the MIC transforms mortgage payments into dividends that land in your investment account each month. MICs operate under a unique legal requirement that sets them apart from other investments. Remember, by law, they must distribute 100% of their net income to shareholders as dividends, a requirement mandated by Section 130.1 of the Income Tax Act. Unlike regular corporations that can retain earnings to reinvest in the business, MICs must pass everything through their investors. This mandatory distribution creates a reliable income stream that many investors seek. Most MICs pay dividends monthly or quarterly, providing a consistent schedule of payments you can count on. This predictable cash flow makes MICs particularly attractive to retirees or others who need steady income from their investments. The distribution process is straightforward. MICs collect mortgage payments from borrowers, subtract their operating expenses and management fees, and distribute remaining income to shareholders. This flow-through structure ensures that income moves efficiently from borrowers to investors with minimal delays. When it comes to taxation, MIC dividends are treated as interest income rather than eligible dividends, meaning they don't qualify for the dividend tax credit that reduces tax on regular corporate dividends. Because of this treatment, many financial advisors recommend holding MIC shares in registered accounts like RRSPs or TFSAs where they can grow tax-deferred or tax-free. The tax advantage of registered accounts can significantly enhance your returns. In a TFSA, your MIC dividend grow completely tax-free, and you don't pay any tax when you withdraw the money. In an RRSP, the dividends grow tax-deferred until you withdraw funds from the account. This tax-sheltered environment can substantially increase your after-tax returns compared to holding in a non-registered account. Many MICs offer dividend reinvestment plans, allowing you to automatically use your dividends to purchase additional shares. This compounding effect can accelerate your investment growth, especially in tax-sheltered accounts where dividends aren't reduced by taxes. Over time, this reinvestment strategy can substantially increase your holdings without requiring additional capital contributions. The combination of regular income and tax efficiency makes particularly valuable for retirement planning and income-focused investment strategies. For retirees, the monthly or quarterly payment schedule provides predictable cash flow to cover living expenses. For long-term investors, especially those using registered accounts, the tax advantages help maximize growth over time. When you invest in a MIC, you benefit from the higher tax rates charged to borrowers and the tax-efficient structure that delivers those returns to you. The entire system creates a direct connection between mortgage borrowers and investors, with the MIC acting as the administrator that manages the process. This dividend distribution system explains why MICs often provide higher income than other fixed income investments. It's not just about higher interest rates, it's also about the efficient structure that maximizes how much of that interest makes it to your account. For investors seeking regular income, the MIC's mandatory distribution requirement gives a reliable stream of payments that can help fund retirement or other financial goals. This predictable income, combined with the security of real estate-backed loans, makes a compelling option for the income portion of a diversified investment portfolio. Now that you understand how MICs work, let's consider how they might fit into your overall investment strategy. MICs represent a powerful addition to income-focused portfolios, allowing you to participate in mortgage lending without the complexities of direct real estate ownership. When evaluating potential MIC investments, review their historical yields, loan-to-value policies, and default track record to pick a manager you trust. These investments work particularly well in registered accounts like TFSAs and RRSPs, where you can maximize tax advantages and compound your returns over time. I will also be starting a mix soon. If you want to know more information including launch date, be sure to check out the description below. In the interim, watch my next video about how you can save money without sacrificing your living standards. Thanks for watching.